Hello, this is Eric Parnell, Chief Market Strategist from Great Value Advisor Group. And it's finally here. After a 2-year wait, the U.S. Federal Reserve is ready to deliver on the interest rate cuts that so many investors have been waiting for. Now, rate cuts are good for the markets, right? After all, added liquidity means higher stock prices. Well, not necessarily. It's important, as always, to take a look at market history to get a good understanding of what we can expect as we enter into this new phase of the economy. Now, one of the things that's important to note is that the rate cutting cycle that we're about to enter is different than those that we've seen since the financial crisis. What makes it different? Short-term interest rates are high relative to long-term interest rates. What does that mean? That you can get paid more lending money to the U.S. government for 3 months than what you're going to get paid for lending money to the U.S. government for 10 years. Now, why would this be the case? Why would investors be willing to accept less to lend money to the U.S. government for 10 years than 3 months? The reason that is because they want to lock in that long-term rate. Because that short-term interest rate, it's about to fall a lot as the Federal Reserve cuts interest rates. So why is the Fed even cutting interest rates? Because they're worried about a recession. And one of the things that history has shown us is that the markets don't like economic recession. We've seen this scenario play out 7 times before in the last 60 years. And if you want to do more research, it's called the steepening of the yield curve. In each of the past 7 instances, we saw the U.S. stock market enter into a double-digit correction, falling on average as much as 28% over an average 11-month period once the Federal Reserve started cutting interest rates. That highlights that important point. Be careful what you wish for. Yes, the Federal Reserve is finally delivering on those long-anticipated rate cuts, and so many investors perceive this to be a good thing for the markets. But history has shown that the market outcome can be decidedly different for an extended period versus what so many investors are hoping for. Now, this type of market correction may sound scary, but it's important to remember where we've been over the last few years. The S&P 500 is up over 50% from where it was during COVID, and we're trading at all-time highs. So even if the stock market falls by 20%, the uptrend that we've seen over the last few years is still intact, and we as investment managers maintain that long-term focus. It's important to remember that we see these types of market corrections over long-term periods of time. It's part of the natural market cycle, and we're prepared for them as investment managers. The biggest key is remaining dedicated to your long-term investment discipline. Thanks for joining us for this latest market insight, and I look forward to seeing you again soon.